Mr. Singh, can you see any grounds at all for revenue to proceed with this case, or any chance at all of revenue winning this case and making this a taxable situation?
You know, I have a lot of sympathies with my former department, but I think in this matter, I don't think they have a chance to win it at the judicial level, at the High Court or Supreme Court level. How, I mean, the shareholder is distinct, the asset is distinct, it has no impact on the income of the company. How they could get away with this, I am not sure how they were allowed to do it.
Rahul, you know, I think Mr. Singh made this point in his the earlier answer that he made, saying if anybody is concerned about the undervaluation of shares, it's other authorities that must deal with this. For instance, RBI has pricing guidelines. But I'm still going to try and look at this from the tax department's point of view. They're looking at a series of transactions which they think seriously undervalue Indian assets. Is there any case for them to be able to tax or prevent those kinds of transactions or create taxable events out of them?
It's difficult, Menka, particularly for a transaction like this, that, you know, what happens if you extend a little further, that Shell has received what you're saying is less than what it should have on issue of shares. So what happens in the hands of the shareholder, the cost of acquisition of the shares become depleted to that extent. So when it finally sells, let's say at a future date, if it sells those shares to a third party and makes a capital gains, so anyway it's going to disclose a higher capital gains in India because its cost of acquisition will be less. So in all cases, Indian revenue will never be a loser. But at the end of the, you know, by taking into any recourse whatsoever, you cannot just bring into account that capital receipt into tax by saying that, you know, there has been undervaluation.
The other thing that I didn't understand in this is how they thought that the full 15,200 crore rupees are the tax amount, and that they did not restrict it just to, if this is a receivable, then the interest that could have accrued on it, notional interest, as so as may be, it's the tax on that interest that we should recover. So they've not restricted themselves on the tax on notional interest. They've counted the full 15,200 crores as the tax amount that ought to be paid to them. Can you explain that a little bit to me, Mr. Saab, because I was not fully sure why they went down that route?
Well, again, I mean, let's take a situation, sort of a reverse situation. If for example, the Indian company had, let's say, two shareholders, right? And let's say two separate independent shareholders. Now, if the company in its own wisdom chose to issue a fresh tranche of shares to one of the shareholders at significantly less than fair market value, or even less than book, let's say, right? Then what is happening is the second shareholder, he loses out to that extent. So therefore, in that case, the entire amount of undervaluation would arguably be a gain to the first shareholder's hand. And because if you see the definition of income under 2 subsection 24, that could bring the entire undervaluation arguably in the scope of income, but then in the hands of the shareholder who benefited from that undervaluation. There is no way how the Indian company can gain. And again, in this case, that situation, which I just described a few moments back, does not really arise, because here there are no two or multiple independent shareholders. Here it is all 100% subsidiary of the same Shell entity.
So what Mr. Saha is saying, Rahul, is that even if they had restricted themselves to taxing just the notional interest on that undervaluation of 15,200 crore rupees, they would have had no case.
That's correct. So you have to have an express law for it, and that's the, I would say, the accepted jurisprudence in the various countries. That you do not do it as a matter of practice. It's only when you're empowered specifically by a law.
But Menka, regardless of that, whether the issue of secondary adjustment is brought into the rule book or not, the point is that on one hand you are saying that this is a loan, a constructive loan, and on the other hand you are saying, no, I'm going to tax that. I mean, you can't have the cake and eat it too, right? So whatever is the undervaluation, they have added that to the tax bill. That's the bigger number. Then on the other hand, they are saying, no, while that is an income, simultaneously I am saying that is also an asset, and therefore you should have earned interest in it. I mean, that is something which sounds a little strange. And one other point which I'm going to add is that there have been significant comments by people that in absence of GAR, could they have done this or could they have recharacterized this? And I was looking at the GAR provision, and if you see the definition of impermissible avoidance arrangement, this particular transaction does not even fit that bill. So even if GAR was to be there, I don't think they could have done this, because GAR starts by saying an impermissible avoidance arrangement has to have a tax benefit to the taxpayer. What tax benefit was the taxpayer, Shell India, trying to get in this transaction? It was just simply trying to get some equity capital. So there is no question of any tax benefit, even if GAR was there in the rule book and they wanted to recharacterize this on the basis of GAR. So any which way you look, it's very, very difficult to understand the logic.
So what I'm going to draw from your comments and the comments of the other panelists, Mr. Saha, is that this is a slam dunk case for Shell, that it should not go in any other way but victory for the assessee.
Well, I will sort of not immediately rush to that, because in the past the tax office has come up with amazing kind of positions, which finally, even if they have found no joy in the courts, somehow or other they have managed to get themselves entrenched in the rule book. You know that, right?
But we're already facing one retroactive amendment in this case, right? Which is the clarificatory expansion to the definition of international transaction. So I don't know if there can be any other further changes to the rule book to make this a taxable event. I'm just wondering, we've gone through several different ways of looking at this from the revenue point of view, Rahul, and it seems to me that none of those arguments stand up with you all. So this should be a slam dunk case for Shell.
Well, I mean, we can only talk about our views, but we have the wisdom of the erudite judges of the High Court or Supreme Court. And, talking about the retroactive amendments on account of international transactions, those were clarificatory. Now, if they want to bring this to tax, that will be a substantive amendment for bringing in a new burden of tax and not just a clarificatory. So I don't think it will be as easy as, just trying to make a retroactive amendment going forward.
All right, gentlemen, thanks very much. This is just the first round. I'm sure, like Vodafone, this one is also going to be a long haul. We'll be back with more as the case is heard in the Bombay High Court. Before I say goodbye, I want to say two things. One, thank you very much to Tax Sutra. They helped us with the information they had on the Shell writ petition. So, Arun Giri, thanks very much. And secondly, the firm team has put together a new mini-series. It's launching on June 1st, Rules of the Startup Game. So make sure you tune in, send us your questions about starting up, and we'll see you next week.